Brown Show, where we talk about all things investing, options trading, and the like. Now, here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to episode 155 of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, Mr. AJ Brown. Today is October 25th. How are you doing, AJ? The market, the street is very happy today.
Yeah, they're happy on, probably some earnings information from yesterday. Did you see Tesla go up something like 22, 23% in a single day?
Which was crazy because on the day we were really dropping because of some other earnings, and it seems like Tesla kind of reversed the course there. And we're still in the thick of a lot more earnings coming down the pipeline.
Absolutely. I mean, it's been a mixed bag. It really has with earnings. And remember what we said last week? We said that the Fed had gotten to a balance point where now they're discussing this dual mandate of employment, getting full employment versus, controlling inflation, which are oftentimes at they conflict with each other. So that's where the Fed is. The Fed has found that balance point where they're like playing with these two variables. So now investors have turned their attention to things like earnings. And then this whole week leading up to, this big excitement yesterday with a lot of the tech stocks being led by Tesla really shooting it through the roof has been about, bonds and kind of sentiment moving forward, bonds getting more valuable, gold getting more valuable, and folks, hedging their bets in the equities market.
So are we being driven up, like, because I'm seeing a pretty big drop in the midweek, and then today we're seeing almost a complete reversal making up for that, which, if we look at your chart, has kind of been the case with any of the pullbacks and sell-offs that we've had, and still continuing to head towards these all-time highs.
I mean, earlier in this week we got our crossing. Now I want you guys to notice something while I'm here. I want you to notice that these crossings that we get, if I draw a horizontal line, they're all at about the same point. This is my lagging indicator, right? This is my 3 and 5 day exponential moving average crossings. And these crossings just don't do it for us, right? Previously, we were getting nice big crossings that came all the way down here, like you can see on my chart. Prior to that, we had these big crossings here. And now we're getting these little touches, maybe for a day or two, and then a move back. So typically these crossings, they confirm that we find a reversal. In this case, a top reversal. But, when you get those reversals and then it jumps right back across like we see here, and then this week as well, right? You can't trust those as confirming indicators. All to say, if I put my trend line drawings back on, I have not reset my trend line saying that we had hit a reversal. In fact, I'm going to be looking at today's close to see where it is with respect to last Friday's close. We're almost last Friday we closed at 5,864 and 67 cents. Our high today so far has been just about just under $2 less than that. So I'm going to be watching the rest of the day to see if we hit a new high, because that's our highest close to date, was last Friday, a week ago. And that could be a reversal, or it could be like what we saw about 4 weeks ago, where we just took a little bit of a breather. I mean, what's the overall conclusion? Well, number one is don't get caught up in a bias, right? Don't get caught up saying it's bullish or bearish or neutral, because the main thing that we can conclude is that things are changing on the fly. there's a lot of uncertainty. And so that's what you can bank on. You can bank on shorter duration trades because, we don't want to plan. We don't want to plan anywhere past a couple weeks to even a month. That's the max we want to plan for, because what we're seeing with all these indicators is just uncertainty. And also, we're supposedly in an uptrend, but we have yet to see that uptrend mature. And when it does mature, we want to make sure it matures up here at this level of resistance. And if it doesn't, well, then that just also adds to our conclusion of uncertainty, because if it reverses, like for instance, if we do find ourselves right here with this being our reversal, then what we can conclude is that instead of having parallel lines of support and resistance, we probably have converging lines of support and resistance, which then lead to more confusion and uncertainty. So that's the only conclusion I have this week, is that we don't know what's going to happen in the long duration, and we shouldn't try to bet or even argue. Don't argue with somebody. If somebody's saying, hey, bear times are in the future, hey, bull times are in the future, the answer is we don't know, and anybody who does put their money on it, will soon be parted with it, because it's a crapshoot right now. All we can conclude is that if there's a way to play on the current uncertainty in the market, we should, and that's what short duration trades are the trades du jour.
Yeah, and we touched on that last week, especially in earnings season, with using some of these volatility options trades.
Yeah,
which we'll review a little bit later. But I guess the assumption to maybe any new investors or traders is potentially sideways chop, right? Especially heading into the election is only a few days away, and who knows what happens if someone's not happy about the results, like we have seen that in the past. But and then we have the rate decision, right, which is still kind of up for debate as to what may happen, but I think everybody's kind of settling into a quarter basis point. Is that right?
Yeah, I was looking at those this morning. Taking a look at November, I mean, the market has all but priced in a quarter point rate drop. So going from where we are 4 3/4 to 5 down to 4.5 to 4 3/4. Look, 95.6%. And then in December, we pretty much have all but priced in another quarter point rate drop. So that for the year, that would be a total of one point rate drop overall this whole 2024. So yeah, I mean, I think almost these are all givens unless some sort of shock goes in the market. I've been watching the bonds market, right? Because the bond market was totally taking money from the equities market earlier in the week, Monday, Tuesday, Wednesday. And some of the speculation around that has to do with who's going to be president next year, and also how much spending is going to happen. And spending not necessarily in social programs, but it could be spending in the form of giving folks tax cuts, big giant tax cuts, or extending tax cuts. So either way, I just saw a poll about which president is best for the economy, and they've been doing this poll every week leading up to the election. They've done it for the last time, and nobody actually believes that either president is going to be good for the economy. I think it was something like 43 for Kamala Harris and 44% for Trump, saying that they actually thought they'd be beneficial. So it's kind of like less than half per point. And yeah. I mean, that's the scoop, right? One other thing that we might look at as well is the take a look over here at what the Fed is doing behind the scenes with their quantitative tightening. So we know that when they tighten at an aggressive rate, the bond rates go down pretty quickly, right? 10-year bonds drop pretty quickly. They kind of have put a little bit of a hold on their bond selling program. So, a lot of people are saying, well, people are speculating about spending and that's causing bond rates to rise. Well, also behind the scenes, if the Fed stops selling back kind of the bonds that they bought with their funny money, that's also going to cause the 10-year bond rate to run, right? We've been seeing articles, or I've been seeing articles all over the different news outlets talking about the 10-year rate, the 10-year bond having a higher rate than it's had, all year. Well, one of the more direct reasons that could be is that the Fed has slowed down in their selling. They're right around that 7 trillion mark of held debt. And so that's interesting.
It seems as if gold continues to be, a high demand asset, Bitcoin,
Mhm.
and so the risk appetite is there. It did have me looking at the VIX this week too. When we
Mhm.
had our little sell off, we were kind of sitting at that 20 mark, and I know we've referenced that a few times. And in general, are we still seeing a higher VIX even though we're hitting these, these high levels? And we've discussed that's good for your premium selling strategies, correct?
Right. So option premiums are kind of at a high compared to where they've been all year. The VIX is at its mean, its all-time mean. So, we're getting higher option premiums than we've ever wanted. So the key here for our investors is, think short, don't think long. So we're not thinking about trades that are going to last 5 months, 6 months, years. That's off the table, at least in the next few months. The other thing is we want to be on the correct side of the equation. So if there's a huge demand for something, we want to be selling it to those people who have a huge demand for it. There's a huge demand for options as hedges right now. So being in the market to selling it to them would be really prudent.
All right. Well, we'll continue and go through some examples. Let's go ahead and pull up your links page real quick. So, we got a ton of good goodies for you guys, and either checking out AJ's most recent earnings webinar, which he did last week. Getting access to the free indicator suite, which you'll see on his chart with the little blue and red arrows. Show some love on the YouTube channel, TikTok, Instagram, Facebook. He's got an awesome daily workshop where he breaks down these 4 premium selling strategies that are very good introductory ways to get into options and using premium selling as a strategy. Learning how to become part of the Trading Trainer program. Maybe you need some coaching and just a ton of good stuff. So the link to all this is in the chat. So head on over there. I know in our next segment, AJ, we're going to be going over one of those volatility rush or crush trades because I know we talked about it last week. So I am looking forward to seeing what happened, what transpired. As always, we are streaming live. So if anybody out there watching has a name that you want AJ to run through, feel free to throw it in the chat. If you have any questions, feel free to throw it in the chat. We've got your pick of the week. We've got your speed round. So we're definitely going to be running through some good examples and follow through on the strategies that we go through every week. So we're going to take a bit of a break here. We'll be back in a few minutes to go over the rest of that juicy stuff. Sit tight, everybody. Coming back.
You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. So when I was seeing the earnings, the Tesla earnings yesterday, 20% on in a move in Tesla is quite a move. It made me think about our volatility rush and crush conversation. And so I know we're not going to go over Tesla, but what did you look at last week and implement, and what's our setup here?
Well, last week, if you remember, we had a user send us a candidate that he wanted us to take a look at during the speed round. That was Tyler from St. Paul, Minnesota. He wanted us to look at 3M, right? So that was ticker MMM. And what I had seen for Tyler was, hey, earnings was coming up this week, and that it looked like it was going to be a good candidate for earnings. And then at the end of last week's AJ Brown show, I said, hey, you know what? I'm going to go ahead and see if it's worth me to trade that. And if I do, I'm going to talk about it. So I did just that. And we used our horizontal calendar spreads type strategy. So just a quick reminder on calendar spreads, some of the characteristics of these things. First of all, any intrinsic value that's in the options that we use in the calendar spread is canceled out, because a calendar spread is where we buy a strike price with a different expiration date, and then we sell the same strike price, different expiration dates. That's why it's called a calendar or horizontal spread, is because it's the same strike price, different expiration date. And it's the strike price and its relation to what the current price of the stock is that determines the in the money or intrinsic value. So if you're buying the same strike price that you're selling, the intrinsic value cancels out. The intrinsic value is also often terms looked at as the real value, or the value of the option when it expires. So you're not even factoring any of that intrinsic value into a calendar spread. What it is it's the difference of these extrinsic values, or the emotional components of the option price. And if you look mathematically at the way this thing works, is it's got kind of a parabolic rise in price up into the strike price. And then if the underlying symbol goes out, and my drawings are not very good, but it's parallel on both sides. It's this parabolic run up and then a parabolic drop down in price. And what we really like about these trades is that they respond fantastically to changes in volatility. So if we use a front month option, that's the one with the closer expiration date, that's literally like days away. We could use a weekly option. And then we use an option that's a couple of months away. That couple of months option is going to remain fairly stable in price based on implied volatility changes, because people who are worried about earnings or thinking about earnings, they're going to hedge their trade with the near term or even the weekly options that are going to expire in a few days. So those are the ones that have the big extremes, right? As people buy them ahead of earnings because they want to make sure they hedge themselves, it causes their price to go up. We call that a volatility rush, right? And then as soon as earnings is released, we get a volatility crush, right? People start selling those options back. I don't need them anymore. I want my money back, or as much of my money back as I can get that I spent on that insurance. And so you see a volatility crush. And what's really nice about this calendar spread is that when you're seeing the volatility rush before earnings, it's a small price. And now I'm drawing the volatility crush. What happens after it crushes is this calendar spread jumps up in price. So we really like it for that reason, because we can take advantage of kind of the known component of an earnings play, is that ahead of earnings, people get nervous and they buy insurance. So we get into the business of selling it to them at top dollar, right? And then after earnings, they want to sell that insurance back, and we're in the business of buying it for a lower price. And we make the difference, right? That's what the calendar spread's so good at. The caveat that we talked about last week, and why we think 3M would be a good trade and Tesla maybe not so much, is that these calendar spreads have a side effect in that they're very gamma influenced. Gamma is kind of the rate of change that they respond to the underlying symbol price change. In other words, we like the ones that have very little change during earnings, kind of like people get excited for no reason when earnings comes. The news is blah blah and very little stock price changes. It just goes on like it's another day and people sell back their insurance. They bought it, but they really never needed to use it, right? So we would prefer to not see very much price change. So with all that background said, here's what I did. We saw that, let me get rid of all this chicken scratch I put on my screen. We saw that earnings was going to be reported before market open, right?
And I have a quick question. Leading into the earnings, do you care if the stock goes up or down, or are you just do you care that it's going to move exponentially?
So the scoop is with these particular horizontal trades, we can withstand a certain amount of movement up or down through earnings, right? But we would prefer for none, right? We would prefer that there be no, change in that price. We can have a little bit, but we don't want too much if we're using the calendar spread. If we think there is going to be a huge price change, then we'll default to a different option strategy like a straddle or a strangle. But for these SIP, so the intrinsic value, the in the money value cancels out. That's great. So that helps us a little bit. But what we're left with, even though it's so nice with the volatility, it's also got this weird gamma component to it. So we really don't want price to change too much. Does that make sense?
Kind of. And I guess we'll know as you go through the example. I was just kind of curious as to the setup leading into earnings, whether you want it to be good or bad or the movement, but it seems as if you kind of don't want much movement.
Well, and it really doesn't matter. I mean, we look at them, the way that we screen these is we look back at previous earnings, especially the one that was 1 year ago on the same date last year, and we kind of see how investors responded. We do a quick soft data analysis to see if there's anything in the news headlines that may cause earnings to be, unexpected. But if we can find a candidate, so we're just like in our premium selling, we're looking for boring ass stocks, right? Ones that aren't in the news, they're not the Teslas. I mean, look at 3M. We're talking Scotch tape. We're talking adhesives, right? Things that are boring, right? They just happen to be there. 3M, makes great products. They also make good money on those products. You can see that they always report positive earnings. They even give a heavy dividend back to their investors. So, you want these stocks that are good companies that are actually quite boring and not in the news headlines very often, right? So what I did was the day before earnings, and so that was on October 21st. I waited till the end of the day. It was well into professional hour. Actually, I got the details right here in my notes. I did one of the trades at 2:54 Eastern time, so right like 6 minutes before professional hour. Professional hour is that last hour of trading. The other one was 3:01 p.m. In fact, maybe I can put this up on the screen so people can actually see what I did. Let me see if I can copy and paste this into a text document for you guys. I wound up doing the December back month option, so the third Friday of December, and the front month option was literally this Friday, October 25th, today. So the trades that I did, I'm going to copy and paste this whole little area here. You guys will see exactly what I did. It's kind of fun because I took a couple of, we had that guest speaker a couple weeks ago, Dan Passarelli. And then he did a private webinar for anybody who wanted to register for it. That's the webinar you put at the top of the link SIP. And so he gave me a heads up during that webinar. He said, if you have a bias in direction, pick the strike price of your option combo that's in the direction of the bias. And if you don't have a bias, then pick the either strike price right around the where the stock is currently trading, and use your puts in the down direction one and the calls in the up direction one. Well, we were trading right around 135. We were trading at 134.40. Excuse me. And so I just did the 135, but I did take his heed, and I did a put calendar spread and I did a call calendar spread. I used the same options in both, except they were puts versus calls. And you can see here, and I did them equally. I'm not going to talk about the number of contracts I did because I just want to show you the per share price. For the one I bought at $2.54, I paid $1.72 per option, or $172 per contract. And on the other side of the equation, $1.98 per option, or $198 per contract, right? And so I bought quite a few of these contracts of both the put calendar spread and the call calendar spread, literally the hour before the end of the market on October 21st. Then earnings came the morning of October 22nd before the market opened. And what I did, and this is the key thing, and this is what I got from Dan, is I set up to have my trades triggered roughly at the same price that the stock was when it was, and some of these trades were going fast. You can see here that even though I programmed my automatic trading to say place the order when the underlying stock is at 134.40, you can see that some of the trades got in, and that's just the nature of the beast. When you use these automatic bots, these automatic conditional trades, you say, okay, trigger the trade at 134.40. So your calendar spread goes down to the trading floor when the underlying symbol is at 134.40. Where it gets filled might be slightly different. So when I looked at it, it looks like my put calendar spread got filled when the underlying symbol was at 131.79, and my call calendar spread got filled when it was at 134.54. Suffice it to say, check out the returns. So this thing that I bought for $1.72, not even 24 hours later, more like 16 hours later, $3.79 per share. And the other one, $1.98, $3.65. All to say, I more than doubled my money in like less than 18 hours, right? I was so impressed, Sip. It worked exactly like Dan had said. It worked like a charm. And I wasn't even in here trading. I programmed these conditional trade details the night before. So kudos to Dan for optimizing my earnings play trades. But that was really a winner.
Yeah, and it's a strategy that we've been talking about
During
earnings season, right? Because things are a little bit volatile, and maybe investors or traders are a little bit more eager to try and get in on any of the movement. But and so I guess, aside from the simple premium selling, the more simplified premium selling, longer term stuff that you kind of teach and educate, this is really, for some of the more active, trigger happy, that maybe still has those risk reward parameters that you like to implement into a lot of your strategies.
Yeah, absolutely. We modeled it out and determined exactly how many contracts I should be buying based on the size of my portfolio and based on the risk of these trades. But the cool thing is you think about earnings, and you think about Tesla before yesterday's earnings result. And did anybody know, first of all, did anybody know what they were going to report? Not unless you got insider information, which is illegal, right? So you didn't know which way Tesla was going to go. And also, more important, you didn't know how the investors were going to respond. So, and that's the same for pretty much any company. You don't know whether or not the stock is going to go up in price because of earnings, or whether the stock is going to go down in price because of earnings. But it turns out that unless the company is really a popular company that gets a lot of news headlines, things like that, for the most part, and we can use some examination and some tools, a lot of the stocks that go through earnings have minimal, they minimally change in price post and pre earnings, right? Unless they have a lot of eyes on them and, a lot of investors in there that can get caught up in buying and selling. A lot of the plays are like 3M, where there's very little, aggregate price action. And so those are the ones that are best for this trade, because even though we don't know what's going to happen with the stock price pre and post earnings, what we do know, and what is pretty much always a given with these stocks, is that ahead of it, people are going to be buying near-term options to hedge their bet, driving that price of that option up. That's the volatility rush. And then right after earnings, literally seconds after the market opens the next day, the options market, they're selling those things back, and that's the volatility crush. And that's a pattern that we can take to the bank. The volatility rush the day before earnings, and the volatility crush the day after earnings. And so, like I said, for the most part, most of the trades that we're going to be doing on this through earnings are going to be these calendar spreads. And if you want, every once in a while, if you've got like a Tesla, then you would use a straddle or strangle, one that's going to have a huge price change. But for the majority of these setups, these calendar spreads work like, they work like fire. They're just fire. And, the scoop is with the little tweaks that Dan gave me, I was getting like 60, 70% ROI. This time around for this trade, I got 101.8% ROI. And I got to thank Tyler in St. Paul. I mean, he gave us this pick out of nowhere last week. And this is what I was saying to him, hey, maybe you should think about doing a spread. And that's when I was like, you know what? I'm going to bring it to the show next week. And here we are.
That's right. And so once again, the link to that, highly encourage everyone to get the full presentation from Dan and AJ going through some of the details and the nuances. So head on over to that all links page. Go ahead and click on the top section, the special earnings webinar. And we've got a docket of more names next week. I think who do we got? We got Meta, we've got Amazon, we've got Alphabet, big names, big tech names that maybe you just watch or do a
straddle or strangle.
Yeah, and take the strategy and see if it would have worked out, and start to work it in, because how many we got, like 2 or 3, 4 weeks left of earnings, right? Maybe like 2 or 3.
And maybe we can find, instead of the Metas and the Amazons, maybe we can find some boring stocks to go pursue, right? Like 3M.
Yeah, without a doubt. And maybe as we run through some of the rest of the names here, because I know that on your charts, you kind of have the little earnings blurb. If it's one that's coming up in the earnings blurb, maybe we could add it to the watch list and see if it would have played out accordingly.
I love it.
But with that being said, AJ, the viewers want to know what's on your docket, what you're looking at this week. And so your pick of the week for this week is a brand that we are all very familiar with, and that is Nike, ticker symbol NKE. What do you like in this week?
So I just recalibrated my chart. I'm using the same free indicators that I've got out for you guys. I switched over from my broad market indicators to my fast app MACD. And I'm digging Nike. Now, Nike's a little bit higher in price than I usually go for, right? But, Nike is looking as though it's going to, earnings is in the rear view mirror. So I'm not worried about any sort of, surprises with any sort of earnings announcements. I'm looking for a reversal sip here at about $78. So I'm waiting for my light blue indicator to come up end of day to tell me that I've got a bottom. I don't want to get into this trade until I've found a bottom, right? But what I'm thinking about Nike, and I've got 3 options here, is either buying some stock when I get that bottom reversal signal, or I could use a substitute option. And I was using my option lookup tool. This is a tool that we just released. And finding substitute options that are trading at parity is just so easy with this tool. So check this out. I'm going to go ahead and type in the ticker symbol. Real simple interface. Just going to use my most recent amount of data. I'm going to look at all the different strike prices. And here's the key. I want to look at price components. And this is something that no other option lookup tool, especially historical option lookup tool, has, right? When we do our price components, we can go out to whatever expiration date we're thinking about. I was thinking about going all the way out to June, or maybe using the April. And with the price components, you can see exactly how much extrinsic versus intrinsic value is in that particular option. So I kind of focused in on this $55 call. This $55 call that isn't going to expire until June 20th of next year. It's got, just under 5% of extrinsic value. So for the most part, while Nike is trading up here at $79, I could have an option that moves dollar for dollar. So if Nike moves from 79 to 80 and change, this option will go from $25 to $26, right? It'll move in lockstep with the stock. So we can get a little bit of leverage, and we can also get a much cheaper price. So instead of buying Nike, I could be buying contracts of this Nike June of 2025 expiration $55 call. Or there's even a third option I was thinking about, and that would be selling cash secured puts, right? So I could come to the November monthly expiration, and if I could basically pick the price that I'm willing to pay. So say, for instance, I'm willing to pay $78. I have to make sure I have $78 to buy a share if I'm going to do this transaction. So I have to have cash in my account. That's why they're called cash secured puts. And don't forget, options are traded in lots of 100. So I have to make sure I have $78 times 100, because I'm going to be buying 100 shares. So in this case, I need $7,800 in cash waiting in my account. But that's a great price looking at where Nike is right now. If I look at where Nike is right now, Nike's trading at $78.88. So if I could get it for $78 and I had, again, I'm going to do this only after I detect a reversal. That's a great price. I get an 88-cent discount on the stock. That's almost a 1% discount on buying the stock. That's not nothing. But the other thing is when I sell this cash secured put, they're going to give me $1.61 per share just for selling that cash secured put. So in addition to getting that 88-cent discount, if somebody does sell me that option for that stock for $78 a share, I've already offset that price by $1.61. And if somebody decides before, November 15th not to sell me Nike at $78 a share, I still get to keep the $1.61. So it's a great way to get into an initial covering position. So I could buy the stock outright. I could buy that substitute call option that doesn't expire until June of next year at a discount, or I could do some of these cash secured puts to lower my break-even price as well. Any of those would work, but that's what I would do if I was, going to be trading Nike. And then I just watch it and look for when I wanted to do my premium trade on it. But it's always getting into the trade first, right?
Yeah, and Nike has as a brand has been struggling this past year. Just I'm not sure why, but definitely not as popular as it has been in the past. But that's the setup of the week. Nike, ticker symbol.
Still making good earnings, still making, it's all relative. Yeah, they're not doing as well as they had, but they're still a business that makes money compared to a lot of businesses out there. They still give a bunch of money back to their investors. And so it's forming that perfect pattern for us to actually turn it into an income generating position. But the first step of any income generating position is to get a covering position. So that's where we're going to go from here.
Did you ever get a chance to watch the movie, the one where they basically convinced Michael Jordan to come wear their shoe?
No.
It's on Amazon. It's phenomenal with Matt Damon. I think Matt Damon, Chris Tucker. It really kind of takes you to the very beginning of Nike, and it's just fascinating that we're sitting here. I don't know how many years later. What was
30
that?
decades. I remember that it was a big thing when I was a kid and riding the school bus. So we're talking early 80s.
Yeah, and that was like Nike was like the yuck brand. Ugh, ugh, ugh. But then
Mhm.
here comes this game changer, and he's like, "Yeah, give me a piece of the pie, and we'll slang Nikes for the next 4 decades and be the number one." So Nike, AJ's pick of the week, ticker symbol NKE. Keep an eye
Absolutely.
on that. All right, we've got a few names from our lovely viewers from all around the country and all around the world. And they want to know, AJ, what you have to say about some of these names. So let's head on down south first. This is Ron in Birmingham, Alabama, interested in a name I'm not too familiar with, Construction Partners.
Mm.
Ticker symbol ROAD.
Mm.
Maybe boring, but it looks like it's seeing some promise here.
Okay, so it was boring, right? I'm looking at a 6-month chart. Let's go back out to a whole year. Not as familiar. I'm like you, not as familiar with this stock. I think so. I do know a little bit. I know that this is a company that, organizes, project manages, and gets things like roads built, right? Especially in the Southeast, Alabama, Georgia, South Carolina, Louisiana, Mississippi, all those states down there. So they're a big road building, and maybe they're benefiting a lot from the Infrastructure Act. That money is trickling out every year for like the next decade. So that might be something here. Here's the scoop, Ron. They were going sideways for a few months there, which would have made a great premium trade. Now they're uptrending, right? If I put a best fit trend line, a linear regression line on here, we can definitely see that they're, on the ups. But they're showing patterns that would really be good for swing trading. So, there's templates that you can follow for finding signals on swing trading. I like to combine a kind of a leading indicator, an overbought, oversold indicator. One of my favorite is Williams percent R from Larry Williams. Have the Williams percent R go to an extremely oversold condition, but don't trade on that indication. Use that as the first step. And when you see that, then look for a lagging indicator to tell you that we've bounced back up. So basically what it's going to be doing is that type of signal will tell you that, hey, we've pulled down and now we're on our way back up. And you can trade that swing back up with that type of combo of indicators. So maybe Williams percent R combined with a moving average crossing, something like that. That's maybe where I would go with this. And one thing that you can think about is if you get into one of these swing trades and you're riding the underlying symbol moving up, whether you're using the stock itself or whether you're using one of these leveraged option positions, in this case, you'd use a call option. Those are covering positions. And what you can do is instead of just blanketly selling that, especially if you think that it's only going to pull back for a little bit and then go higher and keep pulling back and go higher, whenever you feel like there's going to be weakness, maybe use a trailing stop, maybe you just, use a profit stop, whatever that is, instead of liquidating out of that position, liquidating out of those stock shares or liquidating out of those, substitute option shares, collar it, right? sell some premium to offset a protective option. What collaring does is it, it gives you it gives you known reward and risk, right? You can pick the strike prices of that collar and get that known reward and risk. And if the underlying symbol decides to not, get outside of your collar, then you wind up keeping the stock and making all that money off of the premium trade and rolling out that protective option. And you just keep collaring it until either the collar adjusts and gets you out of the position, or, you wind up selling it at a higher price. So think about that for you swing traders out there, that instead of exiting out of your position, when you kind of get that weakness, whether it's, based on a trailing stop or a technical indicator or something like that, throw a collar on temporarily until you resume going in that direction. You'll be able to make money. That's my premium trade combined with a swing trade. I think you're onto something there, Ron.
Yeah, and I'm curious about the fundamentals here. Just seeing that run up in
Yeah.
an industry like construction is very interesting. So, something I might dig into on my end. So, thank you for that, Ron. Ticker symbol Road, company name Construction Partners. Got some swing trade opportunities. All right, moving on to our second name, Bethany in Bethesda, Maryland. Your
That's
neck of
not
the
far
woods.
from me.
It's
Yeah.
interested in AES Corp, ticker symbol AES.
This is an energy play. Okay. Earnings is around the corner here. So, but you'll notice every time there's earnings, there's a little bit of price action, but it doesn't throw this thing off whack too much, right? There's no gapping. There's no surprises. I like the price. Let's see. Earnings is going to come out when? Let's go ahead and switch us out for our arrow tool. That way we can come over here. Earnings conference call. November 1st before market open. So just around the corner next week. It's up to you, Bethany, whether or not you think you can weather earnings. Typically, when it comes to premium trades, you either want to wait until the earnings is released so you're not surprised by anything, or you want to be in your collar, right? You want to be in your sold premium bought protection state. You don't want to be just in the initial covering position, because that's where, you're vulnerable. So I would either suggest that, you get through earnings next week and then think about doing something, or you get into this trade and then quickly put your collar on before earnings. You could also think about one of those earnings plays with this that we did with 3M. I see what you're seeing, though. You're seeing my little blue arrow, which is a signal that we have found a bottom. And so I know that what you're probably thinking you want to do is buy some stock. Or you could, let me see about a substitute option. I'm just going to use my little tool here and swap out AES for Nike. We'll go far out in time. I like that June for substitute options. I don't like these. What I'm seeing here for the options that I would use for substitute options is not enough trading, meaning there's not enough liquidity. There's not enough people trading those options. So you're probably thinking about just buying the stock. And I would say, looks like a good plan. Let's wait until earnings is passed and then look if there's an opportunity to still get this bargain basement price. We definitely are at a level of resistance. But once you're in your stock shares, make sure you buy them in lots of 100. Once you're in your stock shares, let them ride. And then once there's weakness, put that premium trade on. Do the collar.
Yeah, definitely more in the friendly price area, sitting
Hmm.
at about 17 now versus the previous
Affordable for sure.
two examples we just went through that were like 70, 80. All right, thank you for that, Bethany. On to our third and final name in our speed round. Drew in Long Island, New York, wants to know what you think about Xerox, ticker symbol
Mm.
XRX, which
Mm.
traditionally is a pretty boring business model, right? At least
Mm.
nowadays.
Mhm. October 29th, earnings. Okay. It looks like we're going to demonstrate another earnings trade next week, Sip.
And at $10, that could be very reasonable in terms
Very
of
reasonable. It's going to be in the morning of October 29th. That means October 28th. We want to do our let's do a little quick check here. So I'm going to go back and look at the last earnings. 1, 2, 3, 4. You know, Xerox, despite being boring, seems to always make a profit, and they're giving a nice chunk back to their shareholders every quarter. So they're a solid company. But I see this consolidation. Let's see, over here a year ago, earnings had little effect on the stock price here. Actually, the day before and then earnings, you could do the same thing I did, which was just have the order the next day triggered on the same price that you bought it at, where you bought the calendar spread. So I am seeing a little bit of gapping, a little. But I think this would be a nice earnings setup. I'm going to do it, Sip. And this is what I'm going to say to you, Drew. If you're not comfortable with those earnings trades, paper trade it, right? But I'm going to see what I can do. This is October 29th. So this is next week. I'll do this trade again and we'll see, especially since this one has a little bit more history of having some price action. We'll see how well I do using the earnings trades and I'll report back.
yeah, and what was I gonna say? I lost my train of thought. Anyways, Drew from Long Island, stay on the lookout for our little breakdown of the volatility rush, crush, potential
Right.
calendar spread that we'll review next week. So definitely looking forward to that. And heading into next week, AJ, we've got a slew of earnings, which is probably going to continue to keep the market pretty volatile. So with that being said, what are your thoughts? What is your consensus heading into next week? What do you want our viewers to take away heading into the weekend? To utilize, maximize their portfolio dollars.
Well, just really quick, I see somebody typed into the chat. They were asking about the fact that Xerox does not have weeklies. That's okay. We'll use the November 15th, the near term one for our front month, because that's what, put your head into these folks that own the stock, right? Either they're long the stock or they're short the stock, but they don't want something unexpected to happen. So they're going to buy whatever option that they can, and it's going to be the most affordable. So in this case, it'll be the November 15th. And we'll probably use something like the January 17th as our back month. And what we can do ahead of doing this trade is kind of look at, implied volatilities. And we can even go back in time. If you've got access to my options lookup tool, you can see I've got our implied volatilities. If you pull up the Greeks, you've got the implied volatilities, and you can go look at the implied volatilities leading into and coming out of the previous earnings and be able to see how the implied volatilities of the front month options change drastically. They're very high, and then after earnings, they drop. Whereas those back month options, like the January, the implied volatility stays relatively stable, especially compared to the extreme move of the front month. So you can, build a model around this. And that's what we do. I mean, I'm just showing you the results, but I build a whole model around what I'm going to do. So especially I know what price targets to go for, as well as how many contracts to do based on my risk appetite and based on my portfolio size. But, we're going to use the front month as close to near term as we can, whatever that is, because we're going to just be selling what people want to be buying. That's the near term option. And then just flip flop it, right? So that's definitely doable.
And so the access to the options lookup tool, you can head on over to our links page and go into the free indicator suite, and you should be able to get instructions on how to get to access that. And that was actually a great follow-up question. So thank you, Neil. But heading into next week, the end of the month, what are your thoughts on the upcoming election? I mean, has that traditionally had an impact?
I think the market has, in all honesty, I think the market's pretty much priced in the results of the election. I don't think business folks are too happy with either of the outcomes. And I think it's indifferent to a little bit of set. In other words, I think it's not going to be a big deal with the markets. Maybe a little bit of undulation, especially if the election is not determined on, that Wednesday morning, if we have to wait, 2 or 3 days to actually know the final answer to the election. If it's, here's my hope, just because I like certainty, right? My hope is that the polling is wrong and that one or the other, and I don't care which one or the other of the candidates has a clean sweep and it's non-contestable and it's behind us, right? So that we can just go on with our lives.
Yeah, it seems as if maybe historically there may have been more of a impact on markets, but we've had a Trump administration. We're in a Kamala administration, so yeah, I think you're right. A lot of this is priced in, and really, it's more of a spectator soap opera at this point. We're gonna be.
It really is.
Hopefully, everyone goes out and get their vote in, because that.
I mean, I'm done. I did early voting. I did early in-person voting here in Virginia, so.
Well, I have mine sitting on my table, but there's those locals that I don't know who to vote for. So I'm gonna set aside some time, do some research. But at the end of the day, that is the beautiful thing about America and our democracy, is everyone is entitled to their vote. Go ahead and vote. We're gonna see some results here in a couple weeks. But at the end of the day, here at Trading Trainer, whether the market goes up, down, sideways, whether Donald's Trump, whether Kamala's Trump, we're going to continue to be looking for winners, opportunities to make money where we can. And so we hope that you continue to join us in this journey. So if you haven't already, hit that like, hit that follow, hit that subscribe button. Feel free to show us some love. If you have any questions, drop it in the chat. Head on over to the website, hit up the contact page, send us a DM, let us know what you're thinking. Otherwise, hoping everyone enjoys a wonderful weekend. Thank you, AJ. Thank you, everybody, for tuning in. I guess we'll catch you guys next week.
Yeah, be there. Subscribe.
All right. Till then, adios, folks.
Bye.
For tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe